Last week, colleague Abhishek reported that RBI has likely asked some banks to reduce the credit deposit ratio to below 75%. RBI did respond to CNBC TV 18's query, confirming that it has asked some banks to lower the CD ratio. To assess the impact of this development, Govind Singh, Managing Director and Chief Executive Officer at Utkarsh Small Finance Bank, is with us now. Mr. Singh, thank you very much for joining in, and season's greetings to you. Wish you a very, very happy new year. Hope it's a very positive year for you, all your stakeholders, and of course, personally as well. Your first thoughts on the lowering of this CD ratio. I mean, have you heard from the RBI at all? And what do you make of this?
Yeah, thank you, and happy new year to you and your team also. So normally, if you look from the control angle, RBI always expects that CD should be in the range of 75 to 80%. And when we started the bank, and that is true for all the new, you can say converted banks who are earlier NBFC, they become bank. It takes a little longer time for them to reach a certain CD ratio. So normally, the regulator looks at 75 to 80%. And certainly they will ask, banks to go towards that, that trajectory. But normally they will be also understanding that it will take around 5-7 years time to reach that level. So for established banks, for sure, they are in that range. For newer banks, it will take some time. So generally, they will be expecting us to below 100% right now. And that is true for, new banks, whether it is SFB space or even the new universal bank. And that's the trend, and that will continue to be there.
Mr. Singh, morning. So what is your current CD ratio, credit to deposit ratio?
So it's very difficult to give numbers here. You are aware of,
or a range?
Because from today onward it's difficult. But the only one thing I can say, if you look at our Q2 numbers, so it was close to 100%, and it has come down significantly year-on-year basis. And the trajectory continues. In fact, it is coming down on a continuous basis. Our reliance on deposits is more and more on for our advances. In fact, if you look at our quarter two numbers, also we are a net lender. We are always a net lender in money market. Also, there was no money market exposure, and our borrowings per se have come down during this financial year till H1.
Okay.
So the trend is in that direction.
And how many years, sir, will it take for you, in your assessment, to come down to 75-80%?
So normally, as I mentioned, what has been happening, and the way we expect, because you grow and you build your franchise also. My sense is it should take for banks maybe around another 4 to 5 years to reach around 80% or so. And there will be a gradual decrease on a quarter-on-quarter basis.
All right, Mr. Singh, let's talk about a couple of numbers. I recall, in most of your interactions that you have been maintaining that the second half of the year, the NIMs will improve as fresh disbursements will be happening at fresh rates. Do you hold on to that for the second half of the year? What kind of improvement can we see in NIMs? And also, I think you were guiding for a growth of close to AUM growth of around 30%. Does that hold out?
Yeah, so both the things, improvement in NIM maybe around 15-20 basis minimum will certainly happen in H2, as we had guided in while having an earning call for H1, quarter two rather. And similarly, our growth of around 30% plus for this financial year, that also holds good, the way we have guided in the end of September.
All right, give us some more clarity on the AUM breakup. The micro banking AUM, I think it used to account for around 85 to 88% of your total business. That's come down, I think, to the mid-60s. Where is that number headed in the coming years?
True. So, as I mentioned, at the end of September end, it was around 62%. And we do expect this will further come down. And our, you can say, guidance is around, it will reach around 50% or so in next 3 years' time. And that again holds good today also. So maybe, you can say around 1.5%. Decrease on a quarter-on-quarter basis, that will certainly happen. So around 4 to 5% decrease on an annual basis in the micro banking book.
All right. On the credit cost side, I think you have a board mandated floating provision. So if you could tell us what is the credit cost likely to look like, and how much of that will you be accounting for because of this board mandate that you'll have?
So board has mandated that 1.5% of our micro banking, the microfinance book, we should create floating provision by March 24. So that we are creating on a month-on-month basis. So whatever our profitability numbers are there, whatever you see till September, And going forward, also the way board has mandated and the way we have told investors also in our earning call, that will continue. So at the end of March 24, it will be close to 1.5% of our microfinance book in March 23, and that we intend to continue, because that gives a, you can say, shock observer whenever there are decline or for any natural calamities also, we can always handle those things. So that will continue to be there. Our credit cost for quarter 2 was 2.3%, and we are yet to get the numbers, but we do expect that there will be improvement on overall you can say credit cost for the year when you look for the March 24. And I just want to mention this 2.3 includes the additional floating provision, which actually adds to almost 0.3 to 0.4% for the credit cost.
And it will improve from here, is what you're saying. So you end the year closer to 2%?
Difficult to say today. I mean, as I mentioned, it's very difficult to give any number today. But we are certainly expecting, as I mentioned in the earning call also, certainly expecting further improvements there.
Okay, all right. So we'll leave it on that note. Thank you very much for joining in. Good speaking with you today. That's
Same here.
Utkarsh. Thank you very much.